Welcome to our regular Trading the Markets podcast. This week we're looking into the recent moves in the markets and asking if it is possible to contemplate what is now being priced in. Dhaval Joshi, Chief European Investment Strategist at BCA Research, joins us now. Dhaval, is it possible to measure what is being reflected by the markets, or with the recent reaction, negative reaction to the unprecedented amount of monetary easing that's been unlocked, are these markets now dysfunctional, and so we cannot be counting in any meaningful interpretation of this?
I think it is possible to, I suppose, measure the length of recession that is priced in. And at the moment, it is what's priced in is a pretty typical two-quarter technical recession, whereby Q1 and Q2 are going to see contractions in global economic output. Now, the way we can do this is we look at the time horizon of investors that are fully capitulated. And there's a basic rule of thumb which says that a downturn is fully priced when the time horizon of investors who are fully capitulated equals the length of the downturn. So what we're seeing at the moment is that 6-month investors and shorter have capitulated. So they are, what that's saying is that the markets are priced for a downturn lasting that length of time, basically 6 months. And the way we do this is it's actually a technical analysis called fractal analysis. So what we're looking at is something called, I don't want to get into too much detail here because it's quite technical, it's the fractal structure of the market. So what we're saying is that the fractal structure at the 6-month level has completely broken down. And that tells you that we had capitulation at that time horizon. So the bottom line in all of this is that if the recession is a technical recession lasting 2 quarters and we're back into growth or some sort of rebound by July, then we're pretty much priced in. But if the downturn goes beyond Q2, then we have not reached the full capitulation, the full bottom. So that's sort of quite a long answer, but it's an important answer.
Okay, let's take that and examine that a bit further on. Markets are very good at pricing in the future. So, okay, if they're already pricing in this 2 quarters of negative growth, what catalysts will you be looking for to indicate to you that we've bottomed out and we're now then thereafter beginning to see light at the end of the tunnel? And if that light does appear at the end of the tunnel, do we get a V-shaped recovery in the markets, or do we get this long sort of bath-shaped U recovery shape?
So I think the catalyst would be some sort of confirmation that this is going to be a 2-quarter setback. And by the time we get into the summer, the measures that have been put in place to counter the virus will have started to work. So that's the type of thing we're looking at. So, for example, the sort of counter argument against that is that when we hear President Trump, for example, yesterday saying that this downturn is going to extend into July and August. Well, of course, that goes the other way. That's basically saying that we thought it was going to be 2 quarters. Now, someone quite senior, a senior policymaker, is saying no, it could actually go into July and August. In which case, we've kind of got a reverse catalyst saying no, this is not necessarily the bottom. There's further downside. And then what we're saying is you have to look for longer-term investors to capitulate. So we're looking at 3-quarter investors or 1-year time horizon investors to capitulate, and that would then be the catalyst. How do we measure this? Well, we look at this thing called, as I say, this is slightly technical. We look at the something called the fractal dimension of the market. At the moment, we're looking at the 130-day fractal dimension, which is basically 6 months. 130 days is 6 months of working days, has broken down. So the next one we look at is the 195 day, that's 3 quarters, or the 260 day. And when those are broken down, you can say, actually, we've now reached a point where even a 3-quarter recession is kind of priced in, or even a 4-quarter recession. So we're not there yet. But that's what I'd be looking at as the next catalyst to say, well, even if we go into July, August, that's now kind of factored in, but we're not there right now.
Right. Okay. Well, let's if we can take a look in something which is becoming sort of talked about in sort of social gatherings now, and that is what the central banks have been doing, because a lot of what's been happening has been monetary stimulus. And to my mind, monetary stimulus that we've seen just has not worked. The markets haven't picked this up. I'm not quite sure why. To what degree do you think the failure has been the fact that governments haven't followed up with any serious fiscal help to the markets, which perhaps maybe might be more relevant to what's going on at the moment?
That is true, because this is not a typical financial crisis. So I think comparisons with, say, 2008, the great financial crisis, are not particularly valid, in the sense that if you had problems in the banking system, then things like adding new liquidity lines, swaps, lowering interest rates, providing liquidity into the financial plumbing, let's say, will work pretty quickly. Of course, that's not relevant right now, because the issue is not a financial crisis at this point in time. The issue is a biological problem, in a sense. And the impact of monetary policy on a virus or on people's behaviour is quite remote and limited, and therefore it hasn't had the sort of same sort of impact that we had 12 years ago. Mm. And the other point is, even if it does have an impact in the sense that it changes the valuation of all assets, because obviously if you lower interest rates, then the discount rate changes and the present value of all assets changes. But the key point here is that bond yields are already very, very low. So a lot of other assets are priced off the bond yield, not necessarily the short-term interest rate. And if bond yields are already starting at a very low level, the ability to lift asset prices is that much more limited than it was in 2008.
Let me ask you about the recovery as and when it happens. With all this stimulus that's in the market, what about inflation? Is this going to run away? Are we going to see hyperinflation? I think you and I were talking about this about 10 years ago, or 8, 9 years ago, when QE was being suggested by the central banks. Everybody said at the time, crikey, this is going to be something that we could well see, accelerated inflation. But in fact, that never happened. What do you think is going to be the end effect of all the stimulus that we've seen in the last 3 or 4 weeks or so? Is that going to produce unwarranted amounts of upside inflation, undesired amounts of upside inflation?
At this stage, no. I think what the precondition to see a completely uncontrolled inflation would be the central banks lose their autonomy. In other words, they get nationalised by governments. So that in a sense, the governments have free rein to spend as much as they want, with the central bank printing the money for governments to spend. So, of course, you get this all the time in places around the world, like Venezuela and Zimbabwe have had this, and Turkey had something very similar. So the warning sign is central banks losing their independence. So at the moment, we're not even close to that in the major economies like the euro area, where the ECB is fiercely independent. So same with the Fed for the time being, and Bank of Japan, and so on. So that would be the warning sign for me, where it could be that things get a lot worse and governments use emergency powers. Say we are now nationalising the central bank, we are going on a huge spending spree to counter the virus, and we are going to fund that by issuing debt, which the central bank is going to buy in unlimited amounts. So that sort of unlimited deficit spending causes inflation, and that's the thing that would worry me. But until we're there, and we're not even close to being there, I'd be much more worried about deflation for the time being. Right,
okay, I was going to ask you about that, because I think that's the next question, obviously, is does that mean, therefore, we could end up with a deflating situation? Is that something that we should really be worried about, or is that something you think is unlikely to happen?
Well, again, I think that are we going into sort of 1930 type of deflation? No, not yet. No, we're a long way from that as well. In the near term, though, a lot of those headline inflation numbers are likely to come down because of what's happened to the oil price. This is a separate shock, if you think about it. Not only do we have the virus to contend with, but in the last couple of weeks, the oil price has collapsed to sort of sub $30. So even at a headline level, that is going to keep inflation muted for the foreseeable future. Now, you could say, well, does that really matter? I mean, let's look when they look at sort of core inflation. But I think some headline inflation number is still quite important to central banks, and if it stays well below 2%, as it's likely to, then that sort of limits what central banks worry about inflation, because the headline number is not really ticking up, and it's unlikely to tick up dramatically because of what's happened to the energy complex.
Just one final question, and I think you spoke a little bit about some of the central banks and what they've been doing, and the fact the unity of the ECB and so forth. Talking about the ECB, or rather more specifically about the eurozone, the eurozone's been worried about stresses and strains and putting the whole euro area into some sort of tailspin. Do you think this? The coronavirus, the oil price shock, and all that develops around this, we're hearing a lot of concern about airlines and the entertainment industry, travel industry. Do you think all this could put such a strain and a stress on the eurozone that ultimately we could well see the eurozone fall apart? Or does it have a different sort of impact, do you think, all this, on what is at the moment a fragile coalition of what is now appearing to be once again individual countries? Of course, we're seeing borders now being put up. Do you think ultimately the eurozone is better or worse off as a result of this crisis?
Well, I think the interesting thing is that everyone's going through the same sort of crisis, and that's a unifier in a funny sort of way. So that's quite different to if let's say the debt crisis was a crisis focused in Italy, Spain, Greece, etc. And it felt that the North was sort of trying to bail out the South, which of course was not the truth, but that's the way it was often portrayed. This time round, everyone's facing the same sort of crisis. In that sense, it's a unifier. Moreover, it is going to enable a lot of fiscal stimulus to be unleashed, and that's, I think, a good thing for the euro area, because for many years, countries like Italy have been saying, look, we need to do fiscal stimulus. We're stuck with a broken banking system. Fiscal multiplier is high. Normal means stimulus aren't working. This is what we need. So I think now, with this crisis unfolding, Brussels and Northern Europe are going to be much more open to a euro area-wide fiscal stimulus, which I think is going to be a good thing. And this sort of shutting off the border, by the way, is simply to contain the virus. It is not a means of sort of national economy sort of saying, well, look, we're going alone, we're sort of breaking away. It is simply a containment measure to prevent the virus actually going across borders into other areas, other parts of the euro area. In that sense, it's a good thing that countries are closing borders. I don't interpret it in a bad way at all.
Yeah. Okay, Dhaval, look, we'll leave it there, but thank you so much indeed for your time. That's our Trading the Markets podcast for this week with Dhaval Joshi, Chief European Investment Strategist at BCA Research.